What is up, everybody? Welcome back to another episode of Bitcoin and Markets. My name is Ansel Linder. Today is FOMC day. Bitcoin is pumping. We're going to look at the charts. We're going to react live when that drops at 2 p.m. Eastern. It's going to be about 4 minutes. But before we do that, let's share the screen and talk about a few things. Of course, bitcoinandmarkets.com. That's where you go to follow all of my stuff. I just put out a podcast version of one of the live streams this morning. I'm trying to catch up on those still. I've also been working on this post, which might be pretty controversial, and it's about house prices, affordability compared 1950 to today, and probably isn't going to be what you guys expect. So be ready for that one. Just putting the finishing touches on it now, and it will be coming out in a few minutes. Okay. Bitcoin price pumping on the day, 76,615, 630 right now. We will see where it ends up after the FOMC. We could go down to the 1 hour, maybe even the 5 minute to kind of see what we will be getting as a reaction across the board. Let's look at the S&P 500. This again is the 5 minute chart. So gapped up on the open today, and it is higher, still holding those highs. Oil, wrong one, going up on the day, but not significantly. I mean, only $72 per barrel. US 10-year is down on the day. If we go to the daily, we can see it's retraced a lot of that big pump yesterday. So we will see where this ends up after the FOMC. Dollar also retracing a lot of yesterday's gains. Gold, similar, about half. It's a little weaker bounce than the others are selling off. And then we can go back to Bitcoin, and we will be watching this on the 5 minute chart. Okay, so we are here. This is the FOMC website. You can access all their stuff. Last week we had a summary of economic projections. So we will not, that's this little asterisk right here. We will not have one of those this time. You know, those are the charts where they say, oh, this is what we expect GDP to do. This is what we expect unemployment to do. This is what we expect inflation to do. And they're all like best case fairy tale scenarios. But anyway, this is what the one looked like last meeting back in September, FOMC statement. So we're going to go over that one. What they did last time was they cut 50 basis points down to 4.75 to 5%. So we're looking for that change, what it will be. The market is saying that it's going to be 99% that it will be 25 bip cut, but this little 1% chance that it will be a 50 bip cut. And I tend to think that there's going to be a lot more discussion than comes across on this being priced in. They're talking about 50 versus 25. Many of the members of the FOMC are probably leaning towards 50, Powell being one of them. So we will see what happens. Refresh. Still nothing. Market is still kind of coming down from the excitement of the Trump election. It was such a monumental win, winning all parts of the government. So we have the presidency, of course, we have the Senate and the House. And also people are saying the Supreme Court is a conservative Supreme Court. Trump did have, was it 3? I think he had 3 appointments in his last term, and probably will get at least 1, maybe 2 in this term. So that is a very big mandate from the country. Okay, it is out. So let's bring it up. And going down here, so they're going to cut by 1/4 point. So that is 25 basis points to 4.5 to 3 to 4.75. Did I say that right? 4.5 to 4.75 is what they're cutting to. All right, that is right in line with expectations. Let's read through this, and then we'll take a look and see what the market is doing in response. Recent indicators suggest that economic activity has continued to expand at a solid pace. We had GDP 2.8% for, was that Q3? Came in at 2.8%. No. Q3. So yes, it is expanding at a solid pace, but I think that is going to be revised lower, and it is a general trend. So Q3 from 2023 was 4% annualized rate. 2.8% annualized rate is slowing down, right? Since earlier in the year, labor market conditions have generally eased, meaning they're getting worse. The SOM rule has been triggered, and the unemployment rate has moved up but remains low. Okay, but as unemployment starts moving, it's going to move in that direction very, very quickly. Inflation has made, oh wait, yeah, I read that. Inflation has made progress toward the committee's 2% objective, but remains somewhat elevated, and it will get to 2% by the end of the year. Almost certainly, we'll probably start seeing some negative prints here in coming months. The committee seeks not negative year-over-year prints, negative month-over-month prints. The committee seeks to achieve maximum employment and 2% inflation. That's their mandate. Committee judges that the risks to achieving its employment and inflation goals are roughly in balance. The economic outlook is uncertain. You could say that. You could say that. The committee is attentive to the risks to both sides of its dual mandate. All right, and then we read that. All right, so 25 basis points. Let's see if they said anything about the QT. Evolving outlook, and the committee will continue reducing its holdings of Treasury securities and agency debt and agency mortgage-backed securities. The committee is strongly, okay, so it did not say that they're going to reduce the holdings on the same schedule. Let's see what they said back in September about that. The committee will continue reducing its holdings of Treasury securities. Okay, so they said the same thing back then, but let's go two meetings back, and I think they changed the language sometime recently. So no, it looks like, going 2 meetings back, it's the same language, but that's what we have. Now let's go to the markets and see what's going on. So this is Bitcoin selling off on the 5-minute chart here after the Fed has cut rates. But of course, the initial reaction, as I always say, is typically reversed pretty quickly. This will probably end, in about 10, 15 minutes, it'll be much higher. Let's see what gold is doing. Go down the assets here again. Gold is selling off. DXY, big spike in DXY. But if we go to the daily, it's not going to be a significant move. It's still red on the day. And then, so go back to the 5-minute. US 10-year. Yield is somewhat higher here. But again, it's not for the entire day. This isn't that big of a move. And stocks, let's see what stocks are saying. Stocks are reacting least. They're having the least reaction. So that's what we're going on the markets. Let me take a look and see if there's any comments down below in the chat. Nothing yet. Let me check Telegram. And this is just going to be a quick live stream. DT, looked at fees today, unbelievably low. I find this surprising that there's not more demand for block space currently. Thoughts? I kind of talked about that on the Monday newsletter. And my conclusion was that there was some holding of the breath before the election. But now, since we're post-election, I don't know. It's just a very low period right now. A lot of the transactions aren't happening, I guess, on chain. They're happening on databases, so on Coinbase's database and not on chain specifically. I wouldn't worry about anything like right now, what that means as a fundamental. If this goes on for a longer period of time, has the mempool completely drained? Let's see. It was at 75 megabytes on 4 sats per virtual byte. I mean, that's not floor. That's not the floor. If we go out to the 3-month, we can see some of this. Yes, fees are very low, but I mean, they're not much lower than they have been. There's only been a few brief periods. Let's make sure I'm on the right tab here. There's only been a few brief periods where fees have spiked in recent months. But yeah, it's maintaining. I think this is fine right here. But like I said, a lot of the transactions are taking place on custodians now. We got a CK in the house. What's going on, buddy? Is 25 basis point cut more or less bullish than a bigger cut? Ooh, that's a pretty good question. A smaller cut would mean that the Fed is generally less bearish. Okay. Now, for the market, though, I would say it's less bullish because cutting means, it's supposed to be stimulatory, right? We all know that it's not really stimulus to cut rates. Rates go down when money is tight. So the Fed is like simulating tight conditions. But the market typically, at least initially, views these cuts as stimulus. So if you cut less, the market will interpret that as less bullish, where the Fed, behind the curtain, they're interpreting this as less bearish. Because if we are going into a harder recession, or the recession looked acute and imminent, then they would cut a lot bigger, right? So they are less bearish and the market is less bullish. But that's a very good question. Okay, let's see anything else on Telegram. Probably going to cut this one short, guys. I might react to Powell later on a different stream. I might even just do it on Telegram at a later time. I really like reacting to Powell, at least to the first half hour of the press conference. It's entertaining. Okay, let's see. I think CK has another one here. No. All right. That is it then, guys. Thanks for joining me for this quick reaction to the FOMC drop, 25 basis points. Still going in the direction of recession, okay? I put out a post a couple days ago about some rock solid signals that you can watch so you don't flip-flop. There's a lot of people, a lot of macro analysts out there, that they will be flip-flopping on their expectations or their forecasts because, it looks today, this week, it looks really bad. And then 2 days later, it looks really bullish. Look, the 10 years rising. It's going to have inflation and growth. And so if you don't want to flip-flop like that, you can look at some very basic metrics. And the ones I picked out for that post, if you go back to, let's just go to it. Where was it? Right here, reliable recession signals to anchor your forecasts. And we look at yield curve inversions. That's the first one. They are extremely, extremely accurate. We don't go into recession when yields invert, but we go into recession as we come out of inversion. And that's kind of what we've been seeing with the 3-year or 3-month and 10-year spread here. It's inverted, but it's rapidly uninverting. It might have already uninverted. I don't know. But that is rock solid indicator. And I would not make my base case against that. Okay. So it's so accurate with such a long history now. So much evidence that it is a reliable recession indicator that if you make your base case against that, you better have a really damn good reason. Like something is fundamentally different right now. So that's that one. And then also we looked at employment and the SOM rule. So here is the SOM rule. It has to do with the 3-month. I can never remember the exact definition. It triggers when the 3-month moving average of the unemployment rate rises 50 basis points or more from the lowest 3-month average within the past year. So this is just tracking it. I put the red line in here to say when it triggers, and you can see it actually triggers when we're already in recession. If you notice that in the past, it's triggers. It's a real-time recession indicator, and it did trigger. It has come down slightly a little bit. It is acting kind of funny compared to these other ones, but there's been a lot of revisions to the unemployment rate or to the household surveys and that kind of thing. So that could affect how smooth this curve is, but this has triggered as well. So the SOM rule and the yield curve inversions are two very basic things you can look at to not flip-flop, going from soft landing to hard landing, back to soft landing or no landing, whatever the case is. Just look at these things. And I would not, again, you have to build your base case off of some of these very, very reliable indicators. And so That's what I would do. I would build your base case off of that. So anyways, that's that. Oh, CK, will Trump fire Powell? No, I don't think so. I saw something about that on Twitter the other day, or yesterday, it must have been, saying that they were going to nominate a replacement early. So there would be some sort of co-chairmanship there. First off, there wouldn't be a co-chairmanship because they have to get confirmed by the Senate, and the Senate wouldn't do that if Powell was still there. So it wouldn't actually be any sort of co-chairmanship. Also, in the way that this is set up, the bankers right now, the Wall Street banksters that really kind of handpick the Fed chairman and then say, hey, president, this is who we recommend you put up. And so then the president's usually like, okay. So Powell really works for Wall Street, and Wall Street has really pivoted away from the globalists. And so Trump really doesn't have a reason to fire him right now. He's cutting rates. Maybe Trump would want more rate cuts, but don't worry. By January, there will be more rate cuts. There will be at least one more rate cut this year, and then probably faster rate cuts at some point. But there's not really any reason to replace him, and they'll probably make a deal. Trump is really about deals, and so he'll be like, "Look, banksters, I won't replace Powell, but Powell has to play ball. He needs to keep cutting." And I think Powell will be like, sure, that's what I was going to do anyway. So I think there's going to be a deal made. And so Powell will serve out his term. How long does it last? Till May something? I think May is it May of 2026? Let me see. Four-year term set to expire in 2026. So yeah, he's got a whole year to go. We'll see. I mean, if we go into recession, which is the base case, he might get fired. Yes, he might get fired as a way for Trump to blame Powell for keeping rates too high for too long, even though it's not Powell's fault. I mean, the Fed really doesn't do much. They just follow the market. Like what was priced in today, 25 basis points. What did they do? 25 basis points. They don't have like an independent function. We were talking on Telegram, I think, before I went live, that they have never surprised the market, or Powell has never surprised the market. Maybe once in 2019 when they had a mid-cycle adjustment. I don't know. I wasn't paying attention to it, how things were priced in at that time. So they might have been priced in, and but the mainstream media didn't want to believe it, or I don't know, something like that. But usually, ever since I've been paying attention and following exactly, by the minute when the Fed is doing what, then they've never surprised the market. It's always been priced in. So it's not really Powell's fault, but Trump might use him as a scapegoat and say, hey, there. So I don't think it would be really a political thing. It would be like that Trump wants his guy in there or his man in there. It would be as a scapegoat cut. Okay, but very, very good question. Afternoon, Dex, what's going on? Okay, Dennis says, I'm kind of surprised we are just hanging out just above the previous all-time high. I imagined that we would be flying past it with a huge candle. To me, it felt like we had pent-up demand. We do. We have big-time pent-up demand, and it is moving very quickly. It's the watched kettle never boils, right? Was that the saying? Let's go to this. So the Bitcoin has already retraced that entire initial dip. If we go to the weekly chart, I mean, that's pretty sexy candle there. Okay. And so we are going very, very quickly. It just doesn't feel like that right now. But yeah, good point. And like I said, there's nothing really structurally to act as resistance here. Um, Tons of demand from ETF, strategic Bitcoin reserve, front running potential, having, building up the shortage, and um, there's got to be several other things I just can't think off the top of my head. But there's all this demand, and there's no like structural resistance. So yeah, this will probably have a release valve type of thing, but you can't look at it like on say a daily or maybe a shorter time frame. It's not going to be straight up. It's the weekly will be straight up. We'll probably have 2 big weeks here, but yeah. CK, thoughts on tariffs versus income tax? Man, you're coming with the good questions. I I like the tariff idea. I mean, I like the idea of getting rid of income tax. That would be monumental. And tariffs are easier to adjust. Um, I think there's some unilateral capacity to adjust those, right? For the president, it's not 100%, but I think he has some unilateral power to adjust tariffs. And so they're easier to adjust up and down, get rid of, or put on more. And so the income tax, very hard to change. Very, very hard to change. So if he can get rid of that and replace that with a more flexible type thing that will be more responsive to our needs at the time, to popular opinion, then I think that's probably a win. And also, tariffs tax only certain things. They tax obviously imports and exports, and well, imports mainly. And so that would be the US economy could build up internally and it would prioritize internal growth. And I know that there's that argument about, okay, taxes are theft. Okay, I get it. And I agree in principle. But yeah, if you're asking me between tariffs and between income tax, if it's just tariffs, most people are going to be just sitting pretty with very little taxes from the federal government in the United States. Very low. I mean, I don't know exactly how it might affect like the lower class versus the middle class and upper class. I would say upper class would probably be affected more. I don't know if I'd have to think more deeply on that, but they are the ones buying more luxury items that might be imported. The poor are paying for food and rent and more essentials that probably are more local. And so if you want to advantage them, then tariffs might be a better way. Of course, the ultra poor don't pay any taxes anyway, but I'm talking lower middle class, stuff like that. So another great question, though. We'll see. Tariffs. Sorry. It's time to pick up my kid from school. But I think it won't be as easy as he is selling it to get rid of the income tax, but we can hope. CK, if we go into recession, will that hurt Trump's ability to make big changes like get rid of income tax? No, I actually think the opposite. I think that he has a mandate, and a recession will actually give him reason to make big changes. Like, we were handed this recession. That's what he can bill it as. We got this mandate from the people. We have all branches of government, and we were handed this recession. And you guys picked us because we were talking about these big changes. And now we have this ability to address this recession by making these gigantic changes. And of course, the Bitcoin Strategic Reserve is going to be part of that. The income tax thing will be part of that. Taxes on tips, taxes on what was the other thing? Overtime. Of course, if you get rid of income tax, you don't have to talk about that either. So yeah, I think that going into recession actually makes it more likely, which I don't know if people would agree with me on that or not. Okay, let me check Telegram. Now I got to run here, guys. Supposedly, Larry Jr. says, supposedly the federal budget was funded entirely by tariffs and excise taxes until recently when the income tax was imposed. Then tariffs went down. Yep. And the U.S. was more isolationist and non-interventionist. I was listening to a podcast just last night. Which one was that? Who was on it? Oh, it was the What If Altist guy, Rudyard. And he was doing a live stream about the election. And he made a point about different stages of the American Empire. So we have the initial stage of the American Empire up until World War I. And then from World War I to today, it has been a second American Empire. So think about, we were insular, isolated, non-interventionist, we were funded by tariffs, not income tax. Then we became more expeditionary, more outward facing, and more global policemen, and we had an income tax. So we're kind of going back towards the first phase of the American Empire, the American experiment. I also think this is kind of tying these two answers in. The last one from CK and then this one is FDR came to power in the Great Depression, and he had a mandate from the people, and he had 100 days, and he really expanded the scope of government in almost every way, shape, and form. He revamped everything bigger. Okay. I think if Trump is the guy, I don't know if he is the guy, but let's say he can do something big, he could be the reverse FDR. So we have a silent depression right now. Since the great financial crisis, we have this really bad economy that can't get back on its feet because of the form of the money. We're over indebted. We need to change things. And so he could be the reverse FDR to get us out of this silent depression. And that would be like FDR seizing the gold, going off the gold standard, or making it illegal for people to own gold. Now Trump can do the opposite with Bitcoin and go back onto a commodity standard, a Bitcoin standard this time, and make it legal across the board as money, no capital gains tax, nothing, and do all of these other things, make the government smaller. So it's a reverse FDR, going back to the original isolationist, non-interventionist type of United States. Tariffs would protect our domestic industry, and our economy would likely boom. Now, I don't know how demographics puts a stop to that, how hard that will be to unwrap all of the credit markets in the world, because that would be a big thing. So, I mean, it's very, very complicated, but I can see kind of a path. I'm thinking of Dune 2. Remember when he's sitting there and he's like, there's all these ways to fail, and I see one path through that we succeed. So I can see this path, reverse FDR, but will it come to pass? I don't know. Any other comments? All right, guys, then I'm going to bounce out of here. Thanks for joining me. Ansel Lindner, Bitcoin and Markets. If you're watching on Twitter, consider jumping over to the YouTube and Rumble. The links are in my pinned tweet. Like, comment, subscribe over there. Trying to grow the channel, trying to get to 1,000 subscribers on YouTube. So like, comment, subscribe. All right, guys, have a good rest of your day, and I'll see you on the next one. Bye.